Welcome back to another YouTube video, guys. Today we're going to be going over how I was able to net around $6,270 day trading SPX. So I'm going to be breaking down every single trade I took. I'm going to break down exactly what led me to hold it, and I'm going to break down exactly the strategy I used that helped me find the setups for these trades. So here, an overview, you'll see I had around a 50% win rate, 3 winners, 3 losers. I traded 36 contracts and I had a profit factor of 5.01, which is amazing. Most people, they'll see the win rate and be like, oh, he only won half his trades. But, and this is where newer traders tend to mess up, is that the win rate doesn't matter as long as your profit factor is above 2. Profit factor above 2 means that for every trade you took, you lost, you won $2 and you lost $1. So that's what the profit factor means. So going into our trades, you can see I had this one trade for 216%. So you'll see it on SPX, and I had broken this down previously before, but this is something using the box method. So the market here on SPX, the market opened up pretty flat, and we started to continue downwards. Now, I personally thought that we would continue lower after we failed to hold this fair value gap from the day before. Now, I was charting ES, right, which is the futures, not the actual S&P 500 itself, which is what we're seeing here. And I shorted, and the market started to consolidate. My stop loss was at high of day. So if the market broke above high of day, I would have stopped down. I would have lost around 7-8 points, but I was looking to make around 20 points per contract. So the market here, you could see, moved down, and then we started to consolidate. And every time we came up to this high, I took another short, and then I kept adding one by one. And the reason for that is because my stop loss from these ads was around 3 points. So I was fine with taking a little bit more size or just add more to my position because my stop loss was relatively nearby. Now, you're wondering what the box method is, right? And it's a tacky name. It's where you draw a box around the consolidation, you duplicate that box, and then you move it to both sides. For the downside, this is what my price target would have been that exact consolidation area, would be duplicating that box, moving it down, and this was my price target, was 44.83, and it's where you take the consolidation area and then you duplicate it to both sides, and whichever way it breaks out to, you could play the expansion to either side. So here the market moved down, luckily, and I was able to catch the move down to around 44.83, and that was my first trim. Once we saw more expansion downwards, I took more off, and that's really what the trade was. It wasn't anything too crazy. So if we look at the contracts here, you could see how when the contracts came down to this 1.75 area, 1.8 area, the market or the contracts would usually have a bounce because the market was rejecting. So I was trying to get as many ads at this 1.7 to 1.8 area as possible because my stop loss would have been around 1.5. So I was risking around 20 cents per contract to make $100 per contract because that's where my original fill was. And I ended up selling these contracts from 1.7 at 4.6, then around $9, then more around $10. And you can see my running profit here. I was never down more than a couple $100, and the play ran to around $3,000 profit. Now, what most people tend to mess up on is they don't understand how difficult it is to hold a position. Even though it's only down a few $100s, the hardest part about this entire trade was being able to hold through that consolidation and wait for my move to happen, because as traders, we're very impatient people. So I was trying my best to be patient, but it's very, very annoying to see a play go red, then green, then red, then green, then red, then green, and then finally make a follow-through move. So in trading, you have to remember patience is key. Best course of action when you're in a position that's consolidating, it's not really making a move, is to have smaller size and let the play ride. Because what ends up happening for most people is they stop out in this small red, and then the play goes $3,000 in profits, and they're stuck there, and then they get FOMO, and then they chase on the next play and the next play and the next play until they blow their account. So have smaller size, be very patient, and let the play do its thing. All right, you set your price targets, you set your stop loss. Anything in between those two things is just noise. So I took one significant loss, which was around half of my profits. It was a 46% loss on SPX, and I was playing what I thought was a sweep of highs a break of structure to downside, and I rushed my entry because this really wasn't a break of structure. There was no imbalance left behind. This candle that had the imbalance didn't close under this level. So I rushed that play, and then I paid the price for it after. My risk to reward looked something like this. So I was looking at around a 1.6 to 1 risk to reward ratio. I was looking to short this fair value here after we swept these local highs. And this honestly was just a very rushed play. I shouldn't have taken it in the first place. My target was low of day, quickly got stopped out, and I followed my stop loss. And that's the best thing you could do for yourself is know where your stop loss is, know where your target is, and if your stop loss hits, just take it out there. Don't try adding more when your stop loss is hit, right? Most people think averaging down is a bad thing. Averaging down when you should have been stopped out is a bad thing. Averaging down or adding more to your full position when the play is still working in your favor is not bad. But if my stop loss had hit and I kept adding, look what would have happened. I would have gotten smoked. So this play is, a perfect example of why you should listen to your rules and have a plan before you enter a trade. If you have your stop loss and target before you enter a trade, that's one of the most important things in trading is have a plan before you enter a trade, because that's going to save you so much money and so much stress, because that way you know where you're stopping out and you know where you're going to take profits, and that's it. And you make that decision before you actually put money into the play, meaning there's going to be zero emotion behind it. And then you can see I took 2 consecutive 150% gains. And then towards the end of the day, I was able to catch this nice 150% play. This was perfect execution in my end. I personally think so. Even though the play ran crazy after I sold, I bought these contracts at 2.5, sold them at $8, they went to $25 a piece, right? So you would think someone like me would get FOMO, where it's like, oh, I missed out on $10,000 profit. I only made, $2,000. It's like, no, that's not really the case, because I've been doing this so long where I've missed countless opportunities to make hundreds of thousands of dollars. And I have lost a lot of money FOMOing and trying to get that money back. So for me now, it's more of a just, I'm glad I got my take profit. If it goes without me, it goes without me. But I also know the other end of that equation, where it's like if I chase with FOMO, never ends well for anyone. So not just me, but for you guys as well. FOMO is never a good thing, and it took me losing a lot of money to realize that sometimes you just got to stop being greedy and be happy with the profit you made and not worry about it leaving without you. So in this position here, we had a short position added around here, stop loss above this local high, and we were targeting this low down here. So I was targeting this low, and that was around a 4 to 1 risk to reward ratio. I entered this position with around $1,200, $1,300, and was able to close it for around $3,200. Bought 5 contracts at 255, sold all of them at 6.4. And here's my P&L chart. You guys can see we were up $1,500, and then we went all the way down to only being up a couple hundred, and then all the way back up. So most people, what tends to happen is a move like this will happen where they get a nice move. It hasn't hit their price target yet, and then it goes back up, they sell, and then they miss out on the entire move after. That just doesn't happen with me anymore, and the reason why is because I know, and I told myself, I'm like, hey, unless it's my stop loss, unless it's my take profit, there's nothing that's going to stop me from holding the position. And that's what helps me a lot, because I enter with small enough size to where it's like, okay, if I enter this position with $1,200, I'm up $4,000 on the day already. I'll only be up $2,000, $3,000. I'm fine with taking that risk. So when it came down here and it started to bounce, I literally had no fear at all, because I was comfortable with the risk that I put on. I was like, okay, if I get stopped out, I'll lose a couple hundred, maybe $1,000, and then I'll call it a day. It's almost end of day. Where most people start to fail is when they see moves like this happen. They sell up here, and then it starts falling again, and then they chase those moves, and then they get stopped out on a small move like this or this, and then they wonder why they're not making money trading. It's because you're trying to catch every top and every bottom, and you're never going to catch the perfect top or perfect bottom. So you have to be comfortable, and you have to understand that that's never going to happen, where you're going to catch the exact top and the exact bottom every single time. All right? I didn't catch the exact top here. I didn't sell at the exact bottom, but I made $2,000. So that's what you have to be comfortable with, and just understand that, hey, I enter a position, I know what the risk is, and I know what my take profit is. And anything between those two levels is all noise. right? The market is engineered to make you lose. So this move here was engineered to make those people that were short here start to cover, and then they dumped it back down. So I held to my price target, and I sold here for a 4-to-1 risk to reward ratio. Very, very nice play. And overall, these plays were done using supply and demand zones on the hourly time frame. And I'll be going over that in the next video on how to draw zones. And I'm going to be showing you guys my exact strategy. So if you guys want to see what my exact strategy is, feel free to comment what video ideas you guys have, and if you want to see my strategy video and all these plays. If you guys want to get access to my live real-time trading and see when I call a play, see my screen when I'm trading and be on live voice while I trade, feel free to click the first link down in the description, Champs Trading. That's where I host all my classes. That's where I live trade every single day, and that's where I send all my alerts. So if you guys are interested in something like that, go down to the first link in the description, and then there you go. And if you guys were curious about what journaling platform I'm using TradeZella. That'll be the second link in the description. It's one of the best tools I've ever used for trading, and I think it's one of the best things you can do for yourself as a newer trader is journal your trades, see what you're doing good, see what you're doing bad, and then emphasize on the good and get rid of the bad, and then obviously that just helps you as you continue trading. So if you guys enjoyed, make sure you like, comment, and subscribe, and I'll see you guys in the next video.
Privacy behind us. And so another one that we finished in here, it's actually right around the corner, did over 300,000 his first year
on Airbnb.
On Airbnb, and honestly, this one's gonna have some nicer finishes. We're gonna do a matte metal exterior. It's gonna be metal siding, but it's got like a wood grain look to it, white stone. So it's just gonna be really unique. And I appreciate you trusting us that we can make those modifications. It'll be the most unique. Yeah, there's only one.